Well, value in a company is what all boards strive for on behalf of shareholders, and a new index is about to throw a new light on value. I'm joined in the studio by Roger Montgomery from Montgomery Investment Management. Roger, welcome.
Thank you, Tiki. Hello.
Now, the S&P indices is launching the Global Intrinsic Value Index for Goldman Sachs this week. Is this a good development?
It's about time. The problem that we've got, we're all focused on the All Ordinaries Index and we're all focused on the ASX S&P 200. The problem with that index, and the reason why it's performed so poorly, is it's the companies that are in that index, the constituents, aren't in there because they're good companies. They're not in there because they've increased their intrinsic value over time. They're in there simply because they're big. And because
other people in the market have bought the shares, presumably.
Well, that's exactly right. And so there's an argument to get out of, for example, an argument to get out of active managed funds and go into index funds, but indexes are going to produce poor returns if they're based on company size. Qantas hasn't added a cent of intrinsic value in 10 years. Yes, neither has Lend-Lease. Yep. You know, there are many companies. Brambles hasn't either. So there are many large companies that haven't increased their value.
So are all shareholders going to be able to see this index? No, presumably only Goldman Sachs
Unfortunately
clients.
not. The subject of all of that, all of the wrong reasons to be in the press, that company, yes. They're stitching this particular index up for themselves, for their own funds. But that doesn't prevent other fund managers and other banks from doing the same thing. They can actually do the same thing and ask S&P to construct a new index for them based on quality. And that's what we need. If we've got an index based on quality, we can start investing in index funds that make sense.
All right, we'll follow that one. Now, we're seeing possibly enough green shoots for people to start talking about a global recovery. Now, if the recovery story actually takes hold, what sort of threat is that going to bring for inflation?
Well, it means that the quantitative easing that we've seen in the buying of treasuries by officialdom, US Treasury bonds, won't continue. And what we've got is potentially a very dangerous bubble in US Treasuries. I think US Treasuries are one of the least safest places to be invested at the moment, because if you buy a 30-year bond giving you 2%, you are guaranteed to lose purchasing power over time. It doesn't make any sense to have to be able to invite 8 people to dinner this year, but in 5 years' time only 3 with the same amount of money.
So where do you see the money flowing? Very much out of bonds?
Well, ultimately, long-term, I suspect it'll be out of bonds and potentially into equities, but short-term, I'm very bearish on equities as well.
The other scenario, of course, is that we end up a bit like Japan, I suppose.
I think that's the danger, and I think all the stars are lined up for a repeat of the Japan situation, a deflationary scenario, rather than what we experienced in 1922 Germany, when a loaf of bread went from 3 marks to 700 marks in the space of 6 months. I don't think we're going to see that hyperinflation. It is one possibility, but the deflation scenario looks like Japan's experience looks like the more likely scenario for the United States.
Oh, pretty depressing. Roger Montgomery, thank you very much for joining us.
That wasn't the intention, but thank you, Tiki.